Okay, let's unpack this.
Let's do it.
We have spent, what, the last 72 hours? Basically since November 10th, just diving deep into a mountain of SEC filings post Q3 earnings calls.
Yeah, across fintech, streaming, some of those high-growth consumer brands.
And our mission for this deep dive is pretty surgical. We're trying to cut through all that noise.
Exactly. Find the specific nuggets that really show you where the big money is flowing, and maybe more importantly, where caution is starting to creep in. We're giving you the shortcut.
And what's immediately obvious is that the market is celebrating, well, extremes. On one side, you have these massive, almost gravity-defying wins. I'm thinking of a firm on a holding.
Oh, for sure. And on the flip side, you have this very deliberate strategic caution. You see it with Upstart's management, choosing prudence over just raw volume. And you see it in some of the filings, too.
Let's jump right into that, then. The lending landscape, because the signals there are profoundly mixed.
Yeah.
So segment one, fintech's very volatile mix. Big beats, but also some, genuine retreats from risk.
I think the biggest news has to be Affirm, ticker AFRM. Their Q3 earnings just blew past analyst expectations.
What were the numbers?
EPS came in at similar $0.23. The street was expecting $0.11.
Yeah.
And they beat pretty handily on revenue, too.
Right. And that beat, it really just backs up the volume story. They reported a huge jump in what they call GMV.
Gross merchandise volume.
Which just soared. It was up 42% year over year, hitting, what, $10.8 billion?
$10.8 billion, yeah. It tells you the market is absolutely buying into that volume story.
But the real kicker, the thing that I think got everyone's attention, was the partnership news.
Well, absolutely. The Amazon partnership, they announced they're extending it for another 5 years.
5 more years.
Which means it now runs all the way until 2031. Yeah. That is just an enormous runway. It gives them so much confidence in future volume.
It does. It absolutely provides a runway. But I have to ask, does relying on one single massive partner like Amazon, even if it's extended, does that introduce a different kind of long-term risk? I mean, how much of that GMV is really diversified?
That's a totally valid concern. Concentration risk. Yeah. But for now, the market is definitely seeing this as a strategic anchor, not a risk.
Okay.
Now, contrast that with Upstart, ticker UPST.
Right.
They also beat on Q3 EPS, came in at 72 cents versus $42.6 expected. So good beat. But they missed slightly on revenue.
And the real flag, the thing that caught my eye, was their Q4 guidance. It came in way lower than analysts were looking for. They're forecasting $288 million against, what, a $306 million expectation?
Yeah, over 306.
So the question is, why? Why are they actively throttling their own growth?
Well, the management commentary was incredibly revealing on this.
Yeah.
The miss was explicitly because of what they called conservative AI model operation.
Okay, so what does that mean in plain English?
It means they're actively limiting how many loans they approve, even though they have tons of applications coming in the door. Solid volume.
So they are choosing risk management over maximizing immediate volume. That's a much deeper insight than just a simple guidance miss.
Exactly. This isn't just about, general risk management.
Yeah.
It's a strategic vote against the current credit cycle. A firm is optimizing for growth within a stable ecosystem like Amazon. Upstart is signaling that even their really advanced AI underwriting model is, right now, no match for the broader macroeconomic credit risk out there.
So the takeaway from FinTech this week is stability and prudent controls are beating out just aggressive, unmanaged volume.
That's the story. Yeah.
Before we move on, let's just quickly touch on the broader payment sector.
Sure.
PayPal, PYPL, they saw a Q3 revenue and EPS beat. The new CEO seems really focused on profitable growth, especially in the BNPL.
Buy now, pay later.
Buy now, pay later space. And then there's Block.
Right, Block, and see it. Their Cash App borrow volume just skyrocketed. I think it was 134% year over year.
Wow.
And what's interesting there is that today, November 13th, they have this big scheduled event, Cash App releases. And it's all about their AI integration roadmap. So the market is really pivoting from looking at their past earnings to their future strategy.
Okay, that's a great transition. Let's talk about how these digital companies are finding growth outside their traditional models. So moving on to segment 2, digital IP expansion.
Yeah, and the first big development here came from Coinbase, Coin. On November 10th, they launched a new regulated token selling platform.
And why is that so significant?
Well, Bitwise CIO Matt Hugin basically called it a signal of a major return for crypto capital. He suggested that regulated ICOs,
The initial coin offerings,
right, could become a leading theme for 2026. He's positioning them as a potential alternative to the traditional IPO market.
Interesting. So a new way to fund tech.
A new regulated way. And that raises a bigger question. How else are these mature digital companies trying to monetize beyond just, the monthly fee?
And Netflix, nflx just gave us a pretty fascinating answer to
A
that.
very surprising one.
The truly surprising move is Netflix pushing into the physical world. They just announced the official opening of the Netflix house in Philadelphia.
Yeah, physical location. It's a significant move. They're leveraging their intellectual property for a totally different kind of business. An offline, immersive experience.
That has whole new revenue stream.
It's a key physical monetization strategy. And, analysts are still supporting the core business, too. MoffettNathanson reiterated their buy rating. They're focused on the huge growth potential of the ad-supported tier, if Netflix can get the monetization right.
So we've seen digital giants monetizing IP, but maybe the biggest surprise growth story this week was a check on the consumer's wallet. We're shifting from streaming platforms to athletic apparel.
We are talking about On Holding, ONO, the running shoe brand. They delivered an earnings beat on November 12th that just sent the stock flying. It was a massive consumer health check.
The numbers are pretty striking. Revenue was up 24.9% year over year.
But the really vital metric is the 34.5% figure at constant currency.
Explain that. Why is that the one to watch?
Because constant currency, it strips out all the noise from fluctuating exchange rates. It shows you the pure underlying consumer demand for the brand is actually much stronger than that top-line number suggests. This is real organic demand.
And their gross margin hit a record 65.7%.
Incredible.
And the crucial takeaway is that the company responded by raising its 2025 annual guidance. So you have a beat and a raise, which completely defies the narrative we keep hearing about the cautious consumer.
That kind of margin and growth profile, that's premium territory. It tells you that certain high-margin, desirable brands are still commanding pricing power, even in a tougher economy.
Okay, let's transition now into segment 3, where we get into the technical stuff, the often overlooked news that's hiding in SEC filings and analyst reports. This is where you see where sentiment is being quietly tested.
Right. And first up is insider activity. Let's look at Carvana, CVNA, and Wayfair W.
Okay.
So for Carvana, they filed something called a Form 144 on November 12th.
And explain that nuance for us, because a Form 144 is often confused with an actual sale, but it's not.
It is not an actual sale. It is an intent by insiders to sell a significant chunk of stock sometime in the next 3 months. Think of it like an insider suddenly printing out a for sale sign.
Ah, okay.
They intend to put their stock on the market soon. And that signals potential future supply, which, typically concerns investors.
By contrast, Wayfair also had an insider sale. The president, John Blotner, sold about 4,000 shares, but this was filed as a Form 4.
And the key detail there is that the sale was executed under a pre-established Rule 10b5-1 trading plan.
Which means
It was automated. It was scheduled way in advance, maybe 6 months ago. It's just a periodic transfer that happens automatically, regardless of what the company's doing right now. So it's way less alarming than an unexpected sudden sale. Context here is everything.
context is also key when we look at institutional shifts, right? Using the 13F data that just came out. Let's look at Decker's, DCK.
Yeah, and with DK, we see completely conflicting signals. Okay, so on one hand, you have Handelsbanken and Fonder, and they added shares to their portfolio. But then you look at Atria Investments and Congress Asset Management.
And they reduced their stakes.
Significantly. Atria sold off 51.8%, and Congress Asset Management sold a massive 97.2% of their stake.
Wow. Nearly their entire position.
Exactly. So what this 13F data tells you is that despite Decker's being a strong brand, institutions are sharply divided on one thing: valuation.
So one group sees more room to run, but the other group, the one selling almost everything, thinks the stock just got too hot, too fast, and they're locking in profit.
That's the debate right there. And finally, let's look at analyst caution. BellRing Brands, BRBR.
That's the protein products company, not Burberry.
Right, yeah. Premier Protein, that's their big one. Their price target was just reduced by TD Cowen from $45 down to $37.
Why the downgrade for what seems like a pretty stable consumer brand?
Well, TD Cowen cited an anticipated retail growth slowdown. Not now, but in the first quarter of fiscal year 2026.
So they're looking way ahead.
Way ahead. They're seeing early, sector-specific retail tracking data that suggests growth is going to be slower than the market currently thinks. It just highlights how forward-looking pressure can trigger an immediate reaction, long before the numbers actually hit.
So what does this all mean when you put the filings next to the big earnings beats?
It means these technical filings, these targeted downgrades, they remind us that institutional decisions and forward-looking estimates often drive immediate price action and, frankly, investor anxiety more than even a great backward-looking earnings report. You have to track intent, not just history.
That brings us to the end of our dive. We've covered some major tensions this week.
For sure.
You have AI lending grappling with risk. You have Upstart's cautionary model versus a firm's massive Amazon-fueled growth.
We saw major consumer brands like On Holding just defy gravity with incredible margins and raised guidance, and then digital giants like Netflix pushing into physical experiences with the Netflix house.
And we highlighted the subtle but really crucial difference between an insider's intent to sell, that's the CBNA Form 144, versus a routine scheduled sale at Wayfair.
Yeah. We've given you the essential context to understand why certain stocks moved this week, and maybe more importantly, what corporate strategies are now in play as these companies hunt for their next growth vector.
But to leave you with one final provocative thought, the most pressing market event, the one that's going to impact this entire discussion on streaming, is actually scheduled for tonight.
That's right. Walt Disney D's is set to release its Q3 earnings tonight, November 13th.
And those results on subscriber counts, ad revenue, profitability.
They will immediately set the investment sentiment and the entire valuation logic for Netflix, for Roku, for Fubo for the next few weeks. That is the crucial conversation to track next.